Morning everyone, welcome to Ainsley News. It's Monday, start of the week, 11th of April. Today we're talking Fed balance sheet reduction incoming. Late last week the FOMC meetings or minutes from the previous meeting were made public. In them we found the Fed is targeting a maximum of $95 billion in balance sheet reduction per month. That's going to start up in May. The figure is made up of $60 billion in treasuries and $30 billion in mortgage-backed securities. Normally, when various dated US government bonds or treasuries mature, they're rebought by the Fed Reserve. Since the repo meltdown in September 2019, the Federal Reserve has not only rolled over all of the existing debts, but they've been actually buying more. We can see that since July 2020, the debt expansion has been consistent, rising on every angle into the top right of this chart we show you today. This chart shows you all the way back to 2007. It's a bit of a debt chart. It's a bit scary. But if you've been listening to our news, it comes as no surprise. What the minutes of these meetings show is that they're planning to actually reduce the total debt levels for the first time since late 2017 to 19. The proposed tightening is double the size of the previous one. And the result last time was a stock market meltdown in late 2018 that led to the printing presses coming back into overdrive. This movement away from ultra-easy monetary policy comes as the 2- and 10-year treasuries have inverted, as we've talked about in our news over the past week. The 5-year yields were higher than the 30-year briefly. Inversions of the yield curve are the number one indicators of recessions, and the Fed is jacking up rates and reducing the money supply at the same time. We can interpret that as pain ahead. The minutes also made it clear that inflation is recognised as a major problem, and rate hikes are likely to be 50 basis points at each meeting as opposed to the standard 25. The consensus was to raise rates by the full 0.5% at the just past March meeting, but Ukraine concerns saw the group arrive at a 0.25% increase. With the official inflation point north of 8% in the US, the Board of Governors are going to need to jack rates up a lot higher to get positive real rates. Although at this stage the adage of that the Fed is stuck between a rock and a hard place is becoming increasingly ubiquitous in the mainstream analysis of Fed policy. The rock is leaving interest rates low and seeing the currency continue to lose people's faith, and the hard place is saving the US dollar but tanking the stock market, which at this stage is full of zombie companies that can only survive by borrowing at near zero rates to buy back their own stock. Fascinating times. Hope you enjoyed our nice little snippet of news today. Jump over to ainsleyBullion.com.au for all things physical, that's gold, silver and platinum. ainsleywealth.com.au for all things crypto, and goldsilverstandard.com for all things to do with our gold and silver backed cryptocurrency. Enjoy your Monday, everyone. We'll catch you tomorrow for more news.